Good evening, everyone. In today's session, we will discuss about futures trading. So, we will discuss how future trading is done, how to calculate profit or loss in future trading, what are the risks in future trading, what is a lot size, what is the contract value, what is MTM settlement, and what is initial margin. So, first, how future trading is done. So, future trading or futures is a contract between the buyer and seller wherein the buyer agrees to buy and the seller agrees to sell the security on a particular future date at a particular fixed price. So for the stocks and for index like Nifty or Bank Nifty, this future contract is done. And this future contract expires on every last Thursday of the month. So there will be 3 months wherein you can buy these contracts. Now you are in April, so you can buy April month's contract, May month's contract, and the contract of the month of June. So these are called current month contract. The April month contract is current month contract. The May month contract is near month contract. The June month contract is far month contract. So here they have given the example of HDFC Bank. So at that time they were in March. So the March contract is the current month contract. And symbolically it is shown as HDFC Bank MAR FUT. And for April, HDFC Bank APR FUT. And for May, which is the far month contract, HDFC Bank May FUT. For different stocks, there will be different lot sizes. For example, HDFC Bank, the lot size is 500 shares. And for SBI, the lot size is 3000 shares. And this is determined by the exchange. And you have to buy one lot only. Or else you have to buy 2 lots. You cannot buy less than that. Means you have to buy 500 shares of HDFC Bank itself. You cannot buy less than 500 shares. Not SBI, HDFC Bank. And for SBI, you have to buy 3000 shares only. You cannot buy less than 3000 shares in SBI. Contract value. Contract value is the total value of a futures contract. So it is calculated as contract value is equal to lot size into futures price. To take the example of HDFC Bank, the contract value is equal to 500 into 1106.9. So you multiply and you'll get rupees 5,53,450. But in futures, you don't have to pay this whole 5,53,000. You will have to pay around 20% of the 5,53,000. That will be around 1,10,000. So, meaning of future contract. The current price of HDFC Bank, that is spot price, that is the price in equity, is 1,107.3. And the price of March futures is 1,106.9. Here, the futures price is a little less than the spot price. So it indicates the guess of the public. So the public, that is the retail investors, are of the opinion that at the end of the month of March, the price of HDFC Bank will come down a little. It will come down a bit. So there is a discount in futures. So coming to the month of May, the futures contract price is 1,112.35. So it is a bit higher than the spot price. So there is a premium. So that indicates that the public is guessing that in the month of April, the price of HDFC Bank will increase. So the premiums or the discounts indicates the market sentiment. What the people or what the investors, what the traders are expecting for the stock. Let us understand futures trading with the help of an example. So Suppose you buy a future contract. So at that time, there will be three possibilities. The first possibility is that the price of the future will be same as the spot price at the end of the expiry, that is on the date of expiry, on the expiry date. So if it is same as the spot price, then there will be no profit, no loss. Suppose the future price is less than the, means the future price decreases, so it becomes 1076.9. so the purchase price is 1106.9. so there is a decrease of 30 rupees and the lot size is 500, so the trader will incur a loss of 15,000. Let us look at the third example. On the expiry date, the future price is 1146.9. so that means 1146.9 minus 1106.9. so there is an increase of rupees 40. So 40 into 500, 500 is the lot size, 20,000. So rupees 20,000 will be the profit. So when the futures price increases, the trader earns profit. When the future price decreases, the trader earns loss. Mark to market, MTM. Mark to market is called as MTM. So how to calculate MTM? So in futures, there will be daily settlement. So the stockbrokers will calculate the MTM on a daily basis. Means where if the stock price has increased, amount will be credited to your demat account, and if the stock price has decreased, amount will be debited to your account. Suppose same example, HDFC Bank, you have bought at rupees 1106.9 and the price increases by rupees 5 to 1111.9. so 5 into 500, 500 is lot size, rupees 2500 will be your MTM, and that amount will be credited to your account. So you might not have sold the stock, but still because of that increase in the value of your futures holding, they will credit the amount. Suppose the value decreased by rupees 10, then rupees 5,000 will be debited to your account. And if there is no balance in your account, you have to add money to your account, that is rupees 5,000 you will have to add, otherwise they will square off the position. Advantages of futures trading. So after all, why a trader will trade in futures? Because if he is buying 500 shares, why can't he buy straight away in equity, straight away in delivery? The reason is that through futures, the trader can buy shares worth more value than what the amount that he is having. So he will require less money. So if we take the same example of HDFC Bank, the price of HDFC Bank is 1107. So the number of shares is 500. So it will be an amount of 5,53,650. So if he is buying in equity, he will have to invest rupees 5.5 lakhs. But in futures, you will have to pay only 15 to 50% of the amount. So that 50 to 50% is called as initial margin. So usually you will have to pay only 20%. So for an investment of rupees 5,53,000, he will have to pay only rupees 1,10,000. So to be exact, for HDFC Bank, he will have to pay rupees 1,10,690. That is 20% of 5,53,650. Next advantage, short positions for long term. So if you are shorting, means if you are making a short position in equity, on the same day you have to buy it back. On the same day you have to cover it. But in futures, you can carry the short position for the whole month. It will not be possible in equity. Taking the same example, the HDFC Bank futures, he is taking a short position at rupees 1106.9 and the share price decreases. Then he will be able to earn the profit because he has shorted the HDFC Bank through futures. So as you know, you will in short selling, you will earn profits when the share price decreases. But the main thing is that he can wait for 1 month through his short position. Next advantage, less brokerage and taxes. In futures trading, the brokerage and the taxes like CGST, SGST and security transaction tax, all these will be very low. For a short trading, if the brokerage charges is rupees 1000, for futures trading it will be rupees 200 only. That is why many traders prefer to trade in futures, because they will do a lot of transactions, and because the brokerage and other charges is very low, they can make a lot of savings through this lower brokerage and other charges. So this is all about futures trading. Thank you.